Hello, friends. Today I have a very interesting guest in front of me, Mr. Vijay Bharadia, who is the founder of Wallfort PMS, who is heading the division. And Mr. Vijay Bharadia comes with 20 years of professional work experience, having a diverse clientele of more than 100 plus institutions, including banks, insurance, mutual funds, and foreign portfolio investors. And he is playing a pivotal role in enhancing the firm's institutional presence through PMS offering. And he is at the proprietary desk of Wallfort for the last 10 years. And let me invite Mr. Vijay to the show. Hello, Mr. Vijay.
Thank you, Mr. Venkat. Thank you for having me today.
Yes, sir. And first, let me congratulate wholeheartedly on your 45% CAGR on the PMS for the last 5 years, and you have been recognized as the one of the best performing PMS across the industry by the industry association. Also, thank you very much for a stellar performance.
Thank you so much. Thank you very much, sir.
Yes, sir. And let me directly come to the your PMS product positioning. You have your PMS predominantly into mid and small cap with a concentrated focus portfolio. May I know why?
So, according to in my journey of last 30 years in the stock market, we have seen as a family also, we have always been investing in small and mid cap companies which have a potential to grow larger. So the risk reward is favorable. Obviously, the risk is also high, but then you have to do your homework, you have to do your due diligence. And once you get it right, the kind of money you can make in a small cap, you cannot make in a large cap. So with the kind of experience we have, we are okay to take some risk and do proper due diligence and catch the winners early. So a small cap can become a mid cap and a large cap too. So we are trying to find good companies at an early stage so that we can give best performance to our clients, best results to our clients.
And you also run a very focused portfolio. I understand PMS needs to be focused, but you run a portfolio of 15 stocks. Uh,
Uh,
can
yes,
you throw light
so
on that?
good question. But I think, because we are running a PMS and not a mutual fund, I mean, we have the liberty to concentrate the portfolio and the kind of due diligence we do in a particular company, the kind of time we spend before we invest, like meeting the management, visiting the plant, talking to all the channel partners, and doing all the due diligence possible in that particular company from our end. So after that, also, if you're not able to bet like 7.5 to 10% in a particular company, then it doesn't make sense. I mean, the kind of return you want to make, if you want to make good returns, you will have to take concentrated bets where you are comfortable and where your due diligence is very, very thorough.
Wonderful, sir. And I have gone through your investment approach, which is quite robust. Can you explain to our viewers about your investment approach and the stock selection criteria uh, for the
So
betterment of our ends? Yeah.
thank you for this question. So we usually do a top-down approach where we first identify the industry where we feel next 3 to 5 years are going to be very, very good because of some micro macro change or some government policy or some tailwinds in a particular sector. Then we look at the companies between 1,000 and 10,000 crore market cap who can do well in that particular industry and who has a good track record, a promoter has a good understanding of the business, and who can do well in that particular industry, who will be able to take the maximum market share in terms of business. So once we are through with the promoter, then we see the product. I mean, product should have some moat, and then the profitability, and lastly we will not overpay, so the price also has to be reasonable for us to get in. So there are a lot of checks and balances which we go through before we enter any company or a business, because you have to get all right for you to make money. So until we check box all the tick all the check boxes, we do not move forward. So we meet approximately 50 to 60 companies in a year and invest in not more than 2 to 3. So that is the kind of work we do throughout the year to identify these jewels in the market.
Superb, sir. And as you know, we are transitioning from 4 trillion and will become the third largest economy in the next 2 years. I just want to know what are all the major sectors which you are looking at, which are transitioning to a bigger level, which will be part of your portfolio also. Maybe some of the sectors which you wanted to develop on.
Sure. So we have been looking closely in hospital related sectors. Well, because I think medical tourism is going to pick up very, very well in the country. Looking at the cost of treatment across the world, we are one of the lowest cost countries for medical treatment. So I think hospitals will do very, very well. There is data center again, because we are 140 crore people and maximum mobile penetration which we have, and the kind of data we are generating. So a lot of data center will be required, as some norms are likely to change in the near future regarding the data has to be stored within the country and not outside. So data center is another sector which we think will do well. Then shipbuilding is another sector where we are completely dependent on imports of ships, and now the government's focus have slightly changed towards having our own ships and shipbuilding. So we've already seen the larger players move a lot, but there will be a lot of proxy companies, a lot of ancillary companies which will do well. So these are 2 3 sectors where I feel in next 3 to 5 years, if you are able to identify some companies, you will be able to make multi-bagger returns.
Wonderful, sir. And as you know, most of our equity investors used to have the herd mentality of chasing returns. So when they coming to the PMS, what should be the ideal holding period? And in your PMS, what do you like to inform to my
So
our investors?
something which I have mentioned on my website also, and I tell all my clients is, when you have a headache or a stomach ache, you go to a doctor, and that to a specialist. When you want to build your house, you go to find an architect, who is absolutely fit for it. But when you want to make your portfolio, you listen to your friends or anybody who advises you. And just to save this 2 to 10% kind of a thing, you are risking 90% of your capital. So firstly, I mean, it is always best to take professional advice in whichever sector or field you want to go in. So when you take a advice from a doctor or a architect, similarly you have to go to a mutual fund or a portfolio manager. And uh, I think, yeah, that's something which I, and the time horizon which you asked about again. So that is minimum 3 to 5 years, because any company we invest in usually have a longer gestation period, because we are entering because of some micro macro change which is going to happen. Maybe it is capex related, maybe it is some government scheme related. So usually small caps run with a lag. So in 12 months maybe some nothing moves, and in 1 month the stock doubles. So 3 to 5 years is the minimum time horizon which an investor should have to come in. And I would like to add that, I want people not only to look at 3 to 5 year horizon, but look at generational wealth. So the way you invest in land and gold and hold on to them for 20, 30 years and pass it on to the next generation. The same way, if you take the approach in equity and you keep investing your disposable income, maybe 2%, 5%, 10%, how much ever you can spare, and build it over 25, 30 years and pass it on, that will be real wealth creation. So the time horizon should always be very, very long.
Perfect, sir. Wonderful. And sir, currently, as you know, post the election of Trump, there are a lot of trade tariff imposition, and a lot of geopolitical tensions also happened thanks to the recent attack which has happened. And there is the Russia-Ukraine war is going on, and there is some border conflict happening. So, how do you create the margin of safety during those type of turbulent period while
So
constructing the portfolio?
So
Please.
as I said, because we are investing in small and mid cap companies, we usually focus only on companies which have revenues and revenues coming from the domestic market only. Say approximately above 80 to 90% revenues have to be generated domestically, because we are such a large country, and there are enough companies here who will be able to survive for next 5, 10, 15, 20 years easily, with the kind of population and the kind of disposable income which is growing. And as you also mentioned, the kind of economic growth which we are having from 4 trillion, and eventually we'll go to 10 trillion also in next 10
Yes.
years. So I think we are more focused on domestic run companies. By that automatically helps us mitigate the risk of global phenomena.
Wonderful. Yes, sir. Yeah, and I have seen your structure, which is quite easy to understand, where you charge a fixed fee or a variable fee, or whichever, with a clear demarcation. Can you explain on that process?
So we from day one have kept a fixed structure in terms of fees for all our clients, which is 2% fixed fees or 10% profit share, whichever is higher at the end of the year. So we charge 1% at half yearly, and then at the end of the year on 31st March, if the fixed fees is higher, we'll charge one more percent, or if the variable is high, we'll charge variable. We usually try to charge variable, as we don't want to onboard clients for a fixed fees. We usually want to get performance, and we want to partner with our clients, where the more money the client makes, the more money we make. So we want to be partner with our clients, and that is our focus. So yes.
Wonderful, sir. Yeah, that is a very open and practical solution which you offer to the clients. And I just wanted to understand about the your investment team, and what are all the due forensic audit you will be doing, due diligence you will be doing, just to understand the background of your investment team. Yes, sir.
So as I mentioned, once we identify a company, we will go meet the management. We will understand the promoter's capability of executing what he does, and his understanding of the business, his capabilities to execute. Plus, we also talk to his raw material suppliers, to his employees, to his end customers, to maybe some channel partners, and we try to gauge maximum that how his behavior has been over his last 5, 10, 15 years of work work ethics and integrity. So that is what we try to get in the, because in smaller companies it is the first P, which is the promoter, which is one of the most important ingredient. The industry, we've already seen there is tailwind. So if a promoter is good and the business is good, then I think you're bound to make money. So a lot of due diligence goes in. So there are various checks and balances we do. We have appointed few agencies also who we use. We also have some tie-ups with industry experts in almost all the sectors. So we try to get one call with the founder, with that industry expert, to get more understanding of that business. Somebody who's seen a particular sector for 15, 20 years, we usually try to get that person with us for the due diligence, so that we are not making any mistake in terms of accounts and everything. So yeah.
That's very clear, sir. And I just wanted to also understand, you also provide the stock transfer facility for the clients as
Yes,
the
yes. I
exercise.
mean, yeah, stock transfer or cash, both are allowed as per
Both are
SEBI
allowed.
guidelines, and both are allowed. Yes.
Yeah, and the NRI investors can be onboarded also with
Yes,
the
yes. So
complete
we have almost 40 to 50 clients who are from various geographies. I mean, right from Bahrain to Kuwait to US to Canada to Middle East, everywhere. And the process is a little longer, and but yeah, it happens. And the reason for the because of that only we thought of coming out with the AIF, because
Okay.
in AIF the onboarding becomes much more easier. So we are going to start a AIF in next 1 quarter. We
Hmm.
have already prepared and we are going to submit the PPM very soon.
So will it be a category 3 AF?
Yes, it will be a category three, and Wallfort PMS is only going to be the sponsor as well as the investment manager, and the focus is going to be exactly same what we are doing here.
Okay. So it will replicate the same strategy in the current PMS.
Yeah, there I will have a little leeway in terms of investing in few unlisted companies also, which
Hmm.
we might look at. Nothing
Okay.
concrete right now, but
Okay.
yes, we will get the leverage there to,
Okay.
yeah.
And it comes with a closed-ended structure also. That is the additional
AIF
advantage.
Cat 3 is not a close ended.
Yeah, you
Cat
can
3
have
is a open ended
can be
and
open-ended. Yeah,
perpetual. There is no timeline or life of the fund.
fund to be in play. Wonderful, sir. And thanks for providing various insight about your PMS. I think this creates a lot of awareness in my existing investors who are planning for that. And any final message you would like to give it to my investors? And since this is a very sophisticated investment and you come with a lot of due diligence and a lot of groundwork being done, what is the investors' expectation should be, because they should not look at the past return, and
Yeah.
of course we are also doing well as an economy, so what they can expect
So
from your PMS going forward.
Firstly, thank you very much for doing this interview, and thank you, Mr. Venkat. I mean, it's really kind of you to do this. And
My pleasure,
yeah,
sir.
on return expectation, you touched a right point. Okay, our past performance has been, over 45-50% CAGR for
Yeah.
last 5 years, but that should not be the benchmark. I mean, today the risk-free return in the market is not more than 6-7% on FD. So your
Yes.
return expectation should not be more than 15-18%. We try to deliver 25%. I mean, when we look at companies, we usually think in a way that if in 3 years our money can double, that is the only way. We try to invest in companies where we are very, very clear that money can double in 3 years. But the return expectation for clients, I'll tell all my clients, return expectation should be muted so that when we over deliver, we both should be happy.
Yeah.
And looking at the past performance of 40, if we deliver 30, there shouldn't be any complaint.
True. True.
And about the economy, I think we have already touched 4 trillion, and in next 5 years, I think we'll double from here, and in 10 years again, we should reach around 10 trillion. So I think more money is to be made in next 25 years than what we have made in past 25 years. So, I mean, if you've not started the journey yet, you should start it. I'm not saying with me, but I mean, your investing journey should start.
Correct. Great, sir. Thank you very much for the detailed insight, and we thank you for spending your valuable time and explaining
Thank you,
about
Mr.
your
Venkat.
investment process.
Thank you
And
so
we
much.
will connect soon in the future on a different topic. Thank you, sir.
Sure. Thank you so much, sir.